Hello, everyone. Welcome to the Trading Room. This is Darren Fisher. I'm joined by Corey Halliday. This is the Trading Room for July 18th through the 22nd, 2022. So let's get started. As always, trading contains risk. Make sure you're sizing yourself correctly and trade with a good mind. Let's go to last week's news. So the markets continued lower through Thursday, and then it was really a fake out day on Thursday, and then Friday we had a massive rally. I mean, it was looking really good on Friday. The yield curve, though, it continues to be inverted, and the Fed funds futures suggest that a recession is going to be on the horizon, but they're also pricing in some rate cuts in 2024. We'll see how that goes out there. Another news on the currency side is that Euro US dollar is trading at parity, meaning $1 will get you €1. And I haven't seen that situation since probably 2004, I think is the last time that happened. And we're seeing it in the commodities, and they're coming down very, very quickly. As we talked about before, this really looks like demand destruction, and metals are falling sharply as well. The interesting thing, you're going to see it a little bit, oil was down fairly sharply this week, but natural gas is up. And on the international horizon, let's see, RBNZ, Royal Bank of New Zealand, and the Bank of China both raised rates this last week. You can see there the CPI came in there at 1.1. That was the forecast. The actual was 1.3. But I think the surprise that came in was the producer price index on Thursday, the PPI. The month-over-month number was about 1.1%. And I think that equated to, looking at it year over year, it was about 11.1%. So we definitely have inflation. And we've been saying this before. I think it's worse than what the economists are forecasting. It's than what the economists think. We're seeing it in hindsight how much inflation is being played into this. And it's this situation back to the 1970s, I can't believe it, where we have high inflation and slowing economic growth, if not negative economic growth. We've already got 1 quarter of negative growth. And depending on how the growth comes out for Q2, we're probably already in recession. But wait to see what the numbers say with that. So let's take a look at what the markets did. We can see, zooming into the spiders right there, you can see we started the week down from last Friday, and we had 2 down candles, and then while we had a green candle on Wednesday, it was still lower, and then Thursday looked like it was not going to be good at all. And you can see we've got a bit of a lower shadow on there, but we also closed pretty close to the highs, but it was still down. So we had 4 down days, and then Friday you can see we gapped up, had a little bit of volatility there, and we closed we closed almost at our high. So that was definitely looking pretty good. Our market outlook has to change, but I think we're range bound. Corey, what's your view on what's going to be in the markets?
Yeah, I think you're right, Darren. I mean, it was just kind of a choppy week, really, and most of it was centered to the downside. Thursday was the kind of the big day where the US dollar was just ramping higher, and you saw gold and oil and all these things kind of imploding a little bit to the downside, but everything kind of recovered off of that. Everything rebounded back up in the markets, not so much precious metals, but most of the other things. And then Friday was this kind of relief. And, there's a lot of explanations for it. They're giving credit to Citigroup and earnings and this and that. But I think we're just kind of in this choppy environment. So when it looks good, it kind of fakes out to the upside. When it looks bad, it kind of fakes out to the downside, and it's just churning here a little bit, and we're probably going to see a little bit more of that in the near term would be my guess.
Yeah, let's take a quick look at the Qs right there. It's the same story, it's the same situation. You can see we're range bound, on the S&P, probably about the 370 level to 390. Here I'd say the range is going to be between 280 and probably 295 right there. So we're pretty close to that range. This is a very difficult market to trade. You and I were talking beforehand, Corey. I wanted to put on some broad market trades. I couldn't find a good entry point the entire time. I didn't trust Monday's move. Tuesday should have confirmed, but for whatever reason, I sat on my hands just because I thought we'd end up in this situation. I'm glad that I did. these markets, when you get choppy and range bound like this, they're very, very difficult to trade.
Yeah, I mean, on the cues, you can see it kind of responded right there at that resistance, and so you're just in this little range. It's sort of an ascending triangle of sorts, but so maybe we go up and test that. The 50-day is gonna be just above us. So can we get through the 50 and get through this resistance in the next week? Theoretically, that's where buying should follow through, and you would have kind of a nice big spike to the upside. The question is really, are we going to have that sustaining power? I mean, you've got all this overhead supply, you got all these people that bought previously at bad prices that are going to want their money back as markets move higher. So it's going to be hard for the markets to go up in dramatic fashion and really ramp to the upside. You can get these little spikes, but there's willing sellers up above the market, it seems, at each rally. Looking at the VIX, which is kind of an interesting chart, the VIX is really breaking down. It suggests a couple of things. One is that usually the VIX goes lower as the market goes higher, right? An inverse relationship. So volatility goes down as the market recovers, but really what it represents is just overall volatility. And it says, look, we're not moving enough and expected to move enough here in the near term to justify a VIX at 28. So they're selling it off, and now we're at 25. And I don't know where this stops, but it's basically a representation of how much volatility and just how much options should be priced for. And the market's kind of saying we might have a little lull here. It's basically suggesting what we're talking about is that if we're going to stay range bound, you don't want to be paying a lot for options. You don't want to be betting on big price moves. Now, this will probably come to a halt in the not too distant future, but I'd wait for, usually the VIX will kind of give you a big signal. It'll give you maybe a big reversal, a big breakout, some sort of big turning point. And I suspect that when this thing is done going down, it'll give us, it'll be an abnormal day. It'll be one of those days that you can kind of put a star around and say, this was not like every other day. This one had a little more substance to it. So looking at the coming week's events, we're setting up for a choppy week in our minds. A little bit of counterintuitive trading where you probably can't trust too much of what you see. You got to pick your spots a little more carefully and finding those entry points. Make sure to not take, extreme amount of trend risk, because I think as soon as the market looks good, it's kind of faking out and turning back down. So you don't want to get too bullish or too bearish, in my opinion. Kind of play it a little bit more sideways where you have some bulls in the better performing sectors. We'll look at some of those, but healthcare, some other things look a little better maybe than there's not a lot of sectors that look great, but which one's the best house in the bad neighborhood, so to speak. As we look at this week's events, so coming in here, existing home sales are going to come out on Wednesday. The housing market is right in the eye of the storm. It's right there where the Fed is kind of doing things that can hurt housing. Obviously, mortgage rates have gone up as the Fed's been hiking. The Fed is trying to slow down the economy and prices and so on, and not necessarily to cause a housing. They don't want to cause a recession or cause something dramatic, but they got to get things to calm down. And so I think the housing market is one of those areas that you're probably going to see a pretty dramatic rollover here in the data over the next couple of months, would be my guess, because the cost of buying a home and mortgage rates and so on is almost doubled in a relatively short period of time. So there's going to be a little bit of a cooling effect there. Philly Fed is expected to come in negative. Not great to kind of see this downward trend in the economy. We've already been printing negative GDP, and there is debate as to whether we're already in a recession as we speak. Sometimes you're in a recession and you kind of get the data later that confirms, hey, we had negative GDP for multiple quarters and so forth. PMI, as you can see, trending the wrong way, expected to come in at 51.6. Any PMI number above 50 still shows growth, but obviously we're getting dangerously close to negative PMI numbers on the services and manufacturing, with them trending down into the low 50s. So on the economic side, we're starting to see that data come in lower. We're starting to see the economy slowing. That's some of the things that the Fed is trying to do, is calm inflation down. Well, I think we're starting to see that in the data. Commodity prices, I mean, lumber and copper and steel and aluminum and all those prices have come off pretty dramatically. Weekly outlook for us is kind of a zero. My best guesstimate on this is probably that this upward momentum lasts a little bit more. And then I'm not going to be shocked if by the time the week finishes, we kind of finish relatively unchanged. On the monthly outlook, we have pushed above the 20-period moving average, so we're at a -2. Looking at the trends of sectors and so on, you'll see that there's quite a bit of there's more downtrends than uptrends. That's still true. There's more deterioration, broad-based across sectors, than there is strength, and you'll see that as we look at those. So Darren, want to take us through the sectors?
Yeah, that kind of paints an interesting picture. We had a little bit of movement from last week. So starting out with, you can see, we go to that histogram right there. Energy was the worst performing sector. And this is the first time in a long time that I've actually had to go negative on energy. We'll see that right there. Communication services, second worst. That's really no surprise. That's been a weak sector for the entire year. And I think even before that, it was not looking pretty good. It was down across the board. Industrials was down as well. Materials down as well. Everything else down less than 1%. Utilities was the best performer at negative 0.9. But there's a lot of volatility in this. I mean, I think that's what is being reflected. There's a lot of choppy trading. We're going to see that on the individual sectors. Let's take a closer look at utilities right there. You can see it. It had some pretty decent moves. A lot of shadows within utilities. But I'm at a zero on utilities. It was a zero last week. I'm at a zero this week. We're pegged between the moving averages. I think we're range bound in that as well. On to communication services, this one's still at a -2. You could make me the argument, well, we pushed above the 20-period moving average, and so it should be a -1. Okay, I'll buy that. But this thing has been rolling over like an old tired dog all year. So I think it just goes right back down. I mean, this is a pretty good low base right there at the 54 area, and it's not going to take much to push it down through that. Real estate, there's one I'm at a zero as well. It just looks like it wants to stay in that type of range. A lot narrower movement in real estate than a lot of other things. So I think this one is just going to base for a while before it decides to do anything. Moving on to industrials, -1 on industrials. I mean, you could say, the only reason I'm saying that is we're pretty close to that 20-period moving average. We had a really long lower shadow on Friday. We made a pretty good move between Thursday and Friday. So I think it's not a -2 situation, but I think ultimately this does continue to creep lower, just not as fast as a lot of other sectors are going to be doing. Healthcare, looking pretty good. This is probably the best looking sector, I think, is healthcare. We had that volatility again. I mean, you can see the move, Tuesday, Wednesday, and Thursday we had the reversal and gapped up, closed at the highs on Friday. But I think, this is above the 50-period moving average. I think this is one of the better ones. So healthcare, I'm at a +1 on. Financials, not looking so good. I'm at a -1 on financials. It's about the same situation as industrials. We creep lower. We're setting up for a choppy base there between the 31 and 32 area, very narrow range right there. So I think we go sideways for a little bit. And ultimately, I think the next move is going to be down. Consumer, I'm at a 0 on consumer. It's been really choppy. It's been choppy for the past 2 months. You can see right there, between June, but that's narrowing right down there. You could draw a very shallow symmetrical triangle right there. with the top coming down and then, going right up there. It looks like it's a little biased to the downside for that symmetrical triangle. So, eventually I think we do pull down there, but we're gonna base for a little bit before we do that. Tech is another one that I'm just going to put at word to zero, and it's almost the same situation. You draw the same biased symmetrical triangle to right there as you do in consumer right there. Looking at materials, looking at materials right there. I mean, this is clearly a -2. The 20 period moving average is so far away right now. You really can't make a case that it's less bearish than what it was. I mean, this is what we've been seeing. You've seen the commodities. We're seeing it in the materials sector. We're getting demand destruction with inflation on the dollar. It's not a good situation. I mean, this is classic stagflation. I think a lot of those economists are going to have to go and dust off the books that were written in the early 80s to look at what the 70s did so they can get a clue about what's going on right now. Looking at energy, as I mentioned, this is the first time in a long time that I've not either been positive or neutral on energy. Just the way the market action was this week, I think we have to recognize that we're not basing anymore. The theory that we put out that we're going to base is really no longer valid. We made new lows this week, couldn't get back up to the previous week. So, we're in a -1. This is the first time in, probably close to 8 months that I think we've been negative on energy. On the -2, we've got materials and communication services. -1, financials, energies, and industrials. Tech, consumer, utilities, and real estate are all at 0. Neither hot nor cold on there. And healthcare is the only thing that's positive right now at a +1. So let's take a look at some possible trades for this week. In utilities, last week we were short HPP, and that worked out for us pretty well. That was down 4.39%. In utilities this week, we're looking at ETR, Entera Energy Corporation, or Entergy Corporation, excuse me. I think this one goes sideways. I'm looking at the 100, 110, 120 call butterfly. It's fairly wide, but if you can get into that for about $4, then you're going to have a $16 profit window right there. But you've also got to wait until August expiration for that. So if you want to wait until you've got half your profits right there, if it looks to get more volatile, go ahead, take half, and then let the other half run. That's a good way to manage a butterfly position like that. And communication services, last week we were short Facebook, Meta, META, or not short, we were sideways. That went down, 3.62%. So we're probably still in that profit area right there. Just didn't make as much as what we want to. What we're looking at this week is T-Mobile, TMUS. It's in a nice high base right there. It's one of the few things that's looking good in communication services. This has not followed the rest of the sector, you can see. So what we're looking at is we're not expecting a whole lot to the upside right there. We're looking at August, the monthly expiration, 135, 140 bull call. On a $130 stock, that's about as wimpy of a trade as you can get. But we just think with the volatility right there, we just got to pick a direction, size for max loss, and let it run till the end. And healthcare, last week we were long Eli Lilly. That didn't really do a whole lot for us. That was up 0.34% for the week. So if you still got time in that trade, I think it still looks good. But if you're bleeding theta out and you want to just get out of it, that's fine. This week we're looking at AbbVie, ABBV. And again, it's the same situation. This is in a nice high base. It's above the 20 and the 50. The 20 just crossed through the 50, so there's definitely some bullish action right there. And but we're not expecting a whole lot to the upside. So whippy trade, August 155, 160 bull call, and just let it run till expiration right there.
So last week in industrials, we had FedEx as an idea, and FedEx was a sideways trade idea, and that stock was actually down 5% on the week. It along with UPS were down. This week we're looking at IP. Now this is a bear put spread idea, 42.50, 37.50, which would be a push to new lows. You can see by looking at the chart, and this is just an August expiration idea. Essentially, we have established a low, but one of my favorite chart patterns that I look for is basically the cup and handle, and in this case, this is the bearish. This is the inverse cup and handle formation. It's really trading clean and a push down there to new lows at around 37.50 would be the idea. So I kind of like that trade setup and risk to reward. Financials. If we look at financials, last week, what did we have in financials? We had CG, it looks like, on the short side. That stock was sideways. This week, we're looking at Toronto Dominion. Bear rally, but this stock has just been in free fall. I mean, this is a classic example of a stock that's just plunging to the downside, and maybe the old dead cat bounce. So what we were looking at is just August expiration, basically trading a 60-55 put spread. This obviously has a little bit more room to bounce, to play a little catch up. So it might fill this gap in here. Kind of look for a bearish reversal at one of these gap areas would be my thought. As far as an entry, look for a doji or some sort of bearish reversal candlestick formation. This is a gappy stock because it's a Canadian-based company, an ADR, American Depository Receipt, which always leaves a little more gaps. You see all these gaps in the price action. So on the consumer side, last week we had Campbell's as a long idea, and in a down market, Campbell's was actually positive. So a good pick there. This week we're looking at Philip Morris on the consumer side. This would be a consumer staple stock. And again, it's kind of that same look and feel where you've got that level of support. Again, I think it has a little bit more room for a bounce, so I might wait a bit on the bounce, but just playing it super, super conservative. An August 90, 92.50 bear call spread, which is basically sideways. This is a stock that tends to move choppily often, and since it's just been on a big run, it may go into a choppy phase, but ultimately we would anticipate that it finishes at August expiration at about 90 or lower. So down here, kind of at these levels or lower, basically at these lows, I think is a good price target for how this will trade in the coming weeks. We've also got technology, and technology last week we had Bumble as an idea on the long side. It was down 3%. This week we've got Amazon. And Amazon, we were looking at an iron condor, basically expecting the stock to trade and finish at August expiration between 100 and 125 per share. What's kind of interesting about that trade idea is your max profit is if at August expiration it closes anywhere between 100 to 125. That's a big zone. That's a 25% range in terms of where it can land. Now, the risk to reward of it is you could collect, it's a little bit less than a $2 credit, which would leave you, since it's a $5 spread, with about $3 of risk. So it's a little less reward than risk, not quite a one-to-one, but for an iron condor with that big of a range, it's kind of interesting. Now you're going to have to, of course, the stock is going to move. It's not just going to flatline, right? We know it's going to move somewhere, and if it trades up to the top end of the range, the expectation is that it will come in. If it trades down here to the bottom of the range, we would expect a bounce before expiration. So it's kind of that sideways trade where you're expecting it to finish, again, somewhere between about 125 on the low end and above, these lower levels as well. And I think that's a good bet that we finish above the lows but below those highs, given the price action and the expectations we have.
Yeah, let's take a look at materials now. Last week materials, we were short Barrick Gold, and this one came in for us really nicely. That was down 8.85%. So if you're still in that, if you closed out that trade on expiration Friday, it was looking pretty good. If you still have some time in it, I think it goes down. You take a look at the chart, and it looks like it's in some serious trouble. We're playing the same sort of thesis this week with MT, ArcelorMittal, and in a low base right there. It's come down extremely fast, and so it's right there. It's kind of basing right now. So again, we're not going to go out on a limb on any of these things. We're looking at an August 2250-20 bear call, essentially sideways to a little bit down right there. And in this choppy market like this, you don't want to necessarily go for the $5 and $10 spreads. Sometimes it's a 250 spread. Sometimes if it has dollar strikes, sometimes you might just want to do the dollar spread. I mean, this type of environment, nobody wants to be a hero, and I wouldn't recommend that you try to do that either. So that's what we're looking at right there. On to energy. We were short to sideways LNG. That's Cheniere natural gas right there, and that came out pretty good for us. That was down 2.89%. So that trade came out pretty good. This week we're going to be on the short side since we finally went negative on the energy sector. I definitely wanted to look for something that was in a downtrend already and is kind of falling apart. So this is CPE. That's Callon Petroleum. It's come down fast. It's in that low base. So again, we're giving this enough time to work, out to August expiration, give us a whole month, and we're looking at the 40.35 bear call right there. So let's wrap this up here. In conclusion, we're basing with some pretty sharp moves. And as we said, this is a very difficult market to trade. And the last time we had a market like this that I can remember was probably 2015, I think, would have been it. That whole year was choppy. It's very hard to find entry points when we're in that. And in a market like this, I don't know if I'd want to be doing anything short term. So that's why you see all these trades that we had. We're going out an entire month, giving the trade enough time to complete, and we're not expecting a whole lot out of those trades. So also watch your portfolio mix. Market conditions have changed. We're no longer at -3. We're now at -2. So you've got to be less bearish than what you have been in the past. Always watch for proper position sizing. You don't want to have too much of your capital in any trade at all. Spread that out, play the law of large numbers, and you're going to be doing pretty good. This next week, we've got a Thinkorswim class on conditional orders. That's going to be recording. Midweek update, again, is going to be live. That's going to be at 10 a.m. Mountain on Wednesday. And then we're also going to have a recording on Thursday about pivot points. So that's what we're looking at this week. Thanks for attending, everybody. Good trading.